IFRS 16 is really complicated, so I just want to summarize the effects for both lessees and lessors of this accounting standard. So let's start with lessees. The lessee is going to capitalize all leases unless it's a short-term lease, 12 months or less, or a lease of a low-value asset. Low value means less than $5,000 in terms of the fair value of the asset being leased at the beginning of the lease. Okay, so if they capitalize a lease, here's going to be the effects of the accounting on the financial statement. Commencement of the lease, so day one of the lease, they're recording a right-of-use asset, which are going to depreciate over time, which will affect the income statement. We'll get to that in a moment. So they're going to book a right-of-use asset. Even though they don't own this thing that they're leasing, they're going to record an asset, and then they're going to record a lease liability. So these are going to affect the statement of financial position. Okay, the lease liability is the present value of the expected lease payments, and the right-of-use asset, it's a little more complicated. The right-of-use asset you calculate by first taking the initial lease liability and then making some adjustments, adding in lease prepayments, subtracting incentives received from the lessor, adding initial direct costs, and so forth. Okay, now that's at the beginning of the lease. So you record the right-of-use asset, you record a lease liability. Throughout the lease, you're going to record depreciation expense on that right-of-use asset. That's going to affect the income statement. And you're going to record interest expense on the lease liability. Okay, and when you're calculating that interest expense, it's going to be the discount rate times the lease liability at the beginning of that period, where the discount rate is the lessor's implicit interest rate, if the lessee happens to know what that is. And if they don't know what it is, it's the lessee's incremental borrowing rate. That's used to calculate the interest expense. If you add the depreciation expense, you add the interest expense, that's the total amount of expenses related to the lease that the lessee is incurring in that period. Now, remember that the expenses are going to be front-loaded. If you add these together, they're going to be higher in the initial periods of the lease because the interest expense is going to be higher in the beginning of the lease. And that's because the lease liability will be higher, and the lease liability is used to calculate the interest expense. Isn't that fun and exciting? Yes, it is. But let's move on to the lessor. Okay, so the lessor first has to classify the lease as either a finance lease or an operating lease, because that's going to affect their accounting. Okay, if we've got a finance lease, we're going to have potentially, if it's a manufacturer or a dealer, okay, if it's a manufacturer or a dealer, the lessor, then we're going to record a sale and cost of goods sold. Okay, sale and cost of goods sold, and so you're going to have selling profit. Okay, you're going to have selling profit, and then you're also going to have interest revenue. So you're going to have actually two sources of profit if the lessor is a manufacturer or dealer. If they're not a manufacturer or dealer and it's a finance lease, then you would just have interest revenue and there would be no selling profit. Okay, so you're going to have a sale, and you're going to recognize that sales revenue at the commencement of the lease. So that's finance lease for a manufacturer or dealer lessor. Okay, now, whether they're a dealer or not, or a manufacturer or not, if it's a finance lease, you are going to derecognize the asset. It is being removed from the lessor's books, and they're taking the asset off their statement of financial position, but then they're going to record a lease receivable on their statement of financial position if it's a finance lease. Okay, and then throughout the lease, they're going to be recognizing interest revenue, and that's interest on the lease receivable. Okay, so that all pertains to if it is a finance lease. If it is an operating lease, okay, then the lessor is not going to be recognizing any kind of sales revenue, cost of goods sold. They're not going to be derecognizing the asset from their statement of financial position. They're not going to record a lease receivable, and they're not going to record interest revenue because there is no lease receivable upon which they are earning interest. What is going to happen under an operating lease situation is the asset is going to remain on the lessor's statement of financial position, and they're going to depreciate it. And then the lessor is going to recognize lease revenue on a straight line basis throughout the term of the lease.